Well, our top story, there's some temporary relief for average American. The Federal Reserve paused the rate hikes for the first time since January last year.
Right. Last year, the U.S. Central Bank, though, has indicated possibly 2 more rate hikes later this year, though, before a cut in rate hikes next year. Now, the U.S. Central Bank, it kept its lending rate unchanged as well. That's another important point, in the range of 5 to 5.25%.
The pause comes after 10 straight hikes since May 2022. The lending rate since last year has risen by 5 percentage points.
We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
Now, the pause in lending rates comes as inflation has eased in the United States since peaking at 9.1% in June 2022. Inflation eased significantly to just 4.1% last month. Even if one discounts food and energy prices, inflation that's eased considerably. Yet the price pressures remain above the Fed's 2% target.
What we'd like to see is credible evidence that inflation is topping out and then beginning to come down. That's what we want to see. Of course, that's what we want to see.
Powell's statement makes it clear that the Fed still thinks that inflation is a threat to the U.S. economy. The central bank has signaled rates could rise as high as 5.6% with 2 additional rate hikes. In 2024, officials see interest rates falling by 1 percentage point to around 4.6%. That is higher than the 4.3% forecast in March.
The central banks in the Gulf, including Qatar and United Arab Emirates, followed the Fed's decision to hold rates to protect their currencies, peg against the US dollar.
Hong Kong too paused its rate hike cycle following the Fed's decision. The pause in rate hikes, even if it is only a hawkish pause, will give the policymakers a breathing room to see the lagged impact of aggressive tightening so far.
And earlier we spoke to our correspondent Susan Tehrani, who explains what a pause in interest rate hikes means for the average American.
The pause may give a bit of a relief to mortgage rates. However, in the short term, it remains to be seen. Those individuals who have been holding off on purchasing will re-enter the market. As for credit cards, those rates are expected to plateau at a high rate for some time. For something like credit cards, the past 15 months have been quite damaging, and it will take some time for it to get back on track. It's also important to note that while the skip means that interest rates will pause for this month, it's not clear what will happen for the rest of the year and even early next year as well. So these high rates are not expected to disappear. As for inflation, it's important to note that while it is down, Americans are still feeling the pinch, even those who have seen a hike in their salaries, just because the two are just not adding up.
And Susan also tells us about talks of a soft landing and what the economists and experts are saying, and if the U.S. is out of the woods.
Goldman Sachs CEO David Solomon said in a recent interview that he was pleasantly surprised on how resilient the U.S. economy has been despite the challenges it's been facing in the last 15 months or so. However, he did warn that even if the U.S. economy manages to quote unquote muddle through here with a much softer landing that we expected, there may be a scenario where there won't be a recession. However, will certainly feel like a recession. In this situation, he said that Americans would have to buckle up not only for sluggish growth, but also sticky inflation.